Okay, so I'm Jacob Leshno. I'm an economist, not ashamed. And I'm currently in Colombia. I'm just moving to Chicago this summer, so this is a week premature. And what I want to try to focus on in this talk is, let's assume that the cryptocurrency works. Like all the problems that Matt talked about are actually solved. We get a platform that works, that enables users to use it. And the next question is, why do we need this? So we have similar systems that do similar things. What is a cryptocurrency? What does it allow us to do? The simplest kind, Bitcoin, allows you to hold balances and make transfers between users. If you think of Ethereum, a more complicated one, you can do also computations. But all those things are things that you can do on traditional systems already. So there's many ways of moving money already. Like a lot of you probably have Venmo, like use Swift. M-Pesa is cell phone money in Kenya that's very famous. We have all those systems that do this. There's some special features for cryptocurrencies. So if you have a balance in Bitcoin, it's denominated in Bitcoin. Maybe it's good if you like to speculate, but if you're a conventional system, you can make up your own like Facebook money and have speculation too. Transactions are reversible on Bitcoin. You can make a system that has reversible transactions. Lost accounts cannot be retrieved, because if you lose your private key, nobody can give it to you. Venmo can do that. Okay? They can say, if you forget your password, your Venmo balance is gone. So why do we want cryptocurrencies? Well, there's two things that inhibit firms from doing maybe some of those things. First, the firm needs to be trusted. So cryptocurrencies solve the problem of trust. I don't need to trust Bank of America to hold my balances. There's a decentralized system. I trust the decentralized system. I don't have to trust any particular party. But for most people, Bank of America is fine. The second is that you don't need to comply with government regulation if you have a decentralized system. And that may be useful for some means, but is there anything else that we can have that's useful about the payment system? Or another way of asking this is, why shouldn't we want a firm to manage those payment systems? What is the problem of having a firm in charge? Okay? And I want to think of a firm that I trust, like a firm that's doing its job, but still there may be some problems with firms. So let me just kind of do a preface or kind of overview and tell you about two common problems why economists don't like firms. Okay? So the first firm that you don't like is the monopolist. So this is a very straightforward, like classic illustration in economics. It's literally taken from the Wikipedia on monopoly. Okay? And the idea is that there's some amount of quantity that the monopolist could offer. Like how many pieces of bread do I offer in the market? And there's demand. If you offer more bread, okay? There's more people who would buy this, but the marginal guy who buys the bread has lower and lower value of this. If there's one piece of bread, there's somebody who really likes bread, but the millionth piece of bread goes to the person who really doesn't really like bread that much, but you know, there's bread, he'll take it. And there's also some cost for producing more bread. The efficient thing is to produce when marginal cost is equal to marginal demand. So when the marginal unit of bread is just equally good for the next person who will take it. But a monopolist does not generally get like the surplus generated by the bread. Bread makes people happy. Some of it is because people, some of this happiness causes people to pay for the company that produces the bread. Some of it is just something that they're happy with. I bought bread at $10 and it was worth 20 to me. That's expensive bread. So I got $10 of surplus that didn't go to the firm. That will distort the firm's calculation of how much bread should I produce. So there's another curve called the marginal revenue. How much does my revenue go up if I produce more bread? If I produce more bread, the price of bread will go down, and the efficient thing for me is to stop here when my marginal revenue hits my marginal cost, because then I can produce another piece of bread. Somebody would like to buy this, and this will be socially efficient, but it will reduce the price for me, and it's not worth to do so. So as a result, the firm will set this price, this quantity, Okay? So this will be the price. Consumers will get this much. Producers will get this much. And this thing is potential for surplus that we could have generated, but this is lost because the firm doesn't want to serve everybody. Okay, so taking this back to transaction fees and payment systems, you can ask, okay, like this is analysis of a monopolist. In transaction fees, you don't have monopolist. You have different firms competing, but competition between firms is not likely to get you to the efficient outcome either, because each firm is a bit of a monopolist in its users. When you have some system that you're using, suppose we're using Venmo, if all of us are using Venmo, we really don't want to use another system. So Venmo can raise the price on us, and then we'll do less transactions that would be efficient because it's now expensive to use Venmo, but we still don't leave to any other system because it's very hard to move all your friends to this new system. Okay? So you think that this should be relevant for payment system, and if you think of how much Visa and MasterCard are charging for processing transactions, like this is pretty relevant. Okay? Second problem with monopolists, or firms in general, is something that's called the holdup problems. And the classic story is, suppose I have a power plant, and there's two different mines that I can locate next to. Okay? The sulfur mine or the crystal mine. And suppose I can use both of them to produce electricity. Initially, I'm pretty much indifferent between the two locations. I can build my factory anywhere. So I can make those two firms compete, the two owners of those factories, they can compete against each other, and I'm going to get a pretty good price. But then in the next round, I'm going to spend a bunch of money here in building the factory. And the important thing is that's money that I'm never going to get back. Okay? So now it's done. Like I spent a bunch of money, I got into this situation, and now there may be that, oh, I forgot to do something. Like I had a contract for 5 years, but I needed to actually for 7 years. And now I ask, oh, now can I ask the mine to do like some 7 years? Now the situation is very different. He knows that I can't go to anybody else. I'm basically locked in. Now he has all the bargaining power. Now this firm, this mine can hold me up, okay, and basically extract all the surplus that I expect to generate. He can make sure that I just break even, okay, and not make any money. Okay? So what does this mean if you look at payment system? Well, a very common strategy for startups or entrants to markets is that you start by offering your products at a very low price. You build up your network. So Venmo is free, was basically free for everybody for a long while. And then at some point when you have the user base and people are locked in, they have this network effect, now you start to ramp up the price. And this is socially inefficient because as a consumer, I may think I'm going to get locked in. If I think of getting locked in and I say, well, I'm going to do all this cost now, investing to getting on your platform. Once I'm on the platform, I know I'm not going to make any money because like you're going to charge me through the roof because you know I can't leave anymore. Then I'm not willing to make the fixed investment now, the first investment now. And kind of an example of this is when Google had their checkouts. Like there was some kind of talk of like, oh, now all the internet will just do all the payments via Google. But then merchants were like, oh, yeah, it sounds like a great idea to just give Google all the transactions that we have and commit to their platform because they're not going to abuse the power once they control all the payments in the internet, right? Okay? So if I can actually commit not to hold you up later, that may be efficient. So as the mine, maybe I want to say, oh, come to me if you want to make changes later. I promise to you, I'm going to not overcharge you. Okay? That's pretty hard to do. So you can write a contract that says exactly how I'm going to charge in the future, but there's unforeseen contingencies. Anytime there's unforeseen contingency, we're going to renegotiate. I can try to build build a reputation for being fair, and say, I'm not going to charge you through the neck next time because I have a lot of customers. I'm trying to attract other people. And if I'm unfair to you, I'm going to hurt my reputation. That's also hard to do, and you need to be pretty established to be able to sustain such reputation. And of course, there's also cost of enforcement of all of this. Like you may be charging me in ways that I can't detect or or just making the service worse. So there's a bunch of problems with the fact that I go into a firm now, I want to make a long-term decision, I want to get some commitment from the firm. And if the firm can credibly commit, that could be valuable. So, okay, so we have two problems about firms. Like they don't necessarily price at the way that we would like them to price. And we would like them to commit maybe to pricing more than they do. What I'm gonna think about is what does a cryptocurrency do instead? How does a cryptocurrency replace the firm? So here's kind of an illustration. Well, on the left I have something that kind of looks like a traditional conventional payment system. So I have users on this side, and they just interact with the company. And the company internally decides how to manage its servers and everything that's related. And it's a firm, it can price, it can make decisions. A cryptocurrency can be seen as a two-sided market instead. I replaced the firm, and I said, well, financial services, this ability to make transaction, is kind of like oil. You don't need to know who you're buying oil from. You go to the exchange, you buy oil from somebody, it can be anybody, and then people compete in providing you oil. The protocol can be thought of something that's kind of similar. Like I made this financial service thing kind of like maybe not oil, but kind of like Uber. Like there's many other people on the other side, they can compete on providing service to you. And those miners will be the ones that provide the financial services to the users. Well, you're basically going to get the same services as if you got from the firm. But now there's not going to be this monopolist that controls things on the other side. Instead, it's going to be a marketplace, and there's going to be some set of rules here that determine how this thing operates. Yes?
Can you be a little bit more specific on what the service the miners are providing here that is not?
So you want to transact?
Yeah.
Somebody has to hold the servers, verify transactions. They provide this infrastructure for doing this.
Great.
Okay, so two imperfect analogies. Okay. One is, as I said, Uber. That I don't have the bus company or some service provider driving me. There's a bunch of people. They can all just give their computer or car and provide this, be part of the infrastructure that serves me. But there's a second difference, which cryptocurrency is not like Uber because Uber is run by a company. There's a company that determines the rules of the platform. How much do I charge the drivers? How do I decide on the routing? All those decisions are made by a firm. And cryptocurrencies abolish that as well. Cryptocurrency is kind of like a standard, like the Wi-Fi protocol. And this gives you commitment. Why? Because Wi-Fi is hard to change, because I need consensus to change Wi-Fi. I can do whatever I want on my device, which make my Microsoft and broke. But if I just change my device, it doesn't mean anything. It doesn't connect to other devices unless we all come together and together sort of do a constitutional convention and agree that we switch to a new thing. So that creates some commitment in the rules of the protocol. I'm going to treat the rules of the protocol as being literally fixed. Okay. So I basically said those two things, or three things. Oh, and a third thing that I'm going to mostly ignore for the talk today is that for a cryptocurrency to operate, you actually need the balances to be denominated in a coin, because you're creating your own ledger. For people to think of this ledger as being valuable, that means that you created a new thing that's valuable, a new coin. I'm mostly going to ignore this for this talk today. And what I'm going to focus on is what this marketplace now needs to do. So we got rid of the firm, but we still need to provide service to customers. And there's 4 different things, oddly defined here, that we need to decide on. So the users should be paying something to run this, because it still costs something to run this. Miners are providing service to the platform. I still need to reward them in some way. I need to pay them for providing those services. I need to decide what kind of service I offer to the users. And I need to decide what kind of services do I need to procure from the miners. How many miners do I want? That's going to be something that the system, the marketplace, will determine via equilibrium. Okay? So what I'm thinking about is we have a protocol that sets the rules for the marketplace. And then I have those two sides of participants, and I'm going to get an outcome that's going to be determined in equilibrium given those rules. And I'm going to, for the purpose of the next 30 minutes or 25 or however long I have, I'm going to think of those rules as really fixed. Okay? So you can think of how do I make changes to the rules. Yeah? But let's first think of just how to change the rules. We're going to think of them as really literally fixed. Okay? And that's going to be a challenge. Because Uber actually has the power of change things if it says that the pricing was wrong. Like when we commit to the rules, we actually commit not to change the prices even if we see that something is wrong. So that may be something to keep in mind. Okay. So all of this is kind of pretty general level. Let me jump into a very specific protocol and analyze this and think about how does one particular marketplace operate, how functional it is, and what lessons can we draw from this. Okay? So I'm going to think of Bitcoin. Let's think of the Bitcoin protocol as Alex described earlier today. And I'm going to think of the Bitcoin protocol as a marketplace that has the... You're here, right? Yeah, sorry. So a marketplace that gives us the following rules of the marketplace. And I'm going to make a pretty high-level abstraction, but here's what it means for participants in the markets. So first, if you're a user, you get to choose what transaction fees you want to pay. Okay? So that's a pretty distinct feature. There's not that many systems where you say, I'm going to pay how much I want for the service. Second, pretty distinct feature is that the system throughput is independent of how many miners I have. So one way to think of how blockchain works is periodically, or like let's say every 10 minutes in Bitcoin, I randomly select one miner, and this miner gets to mine a block. A block is just a batch of transactions, and it's limited in size. It used to be 1 megabyte. Now in Bitcoin Cash, it's 8 megabytes. With SegWit, it's a bit more complicated. But it's a limited number of transactions that go into every block. So I don't care how many miners I have. The system adjusts the difficulty of finding a valid hash so that every 10 minutes, or however long it is, we find one block and process one batch of transactions of limited size. Okay? In Bitcoin, the block arrival process is a pass-on process. Because I have a lot of people trying to get the nouns independently, it's actually very close to it's very close to a pass-on arrival process. So I'm going to get on average a block every 10 minutes, but sometimes it's going to be a block after 5 minutes, sometimes after 15 minutes. Okay? It's only going to be on average 10, but there's going to be some randomness. And that may seem like a technical detail, but we'll see that it actually matters a lot. Free entry and exit of miners. So we talked about proof of stake, proof of work. One of the things that proof of work allows you to do is that anybody can become a miner. So miners can decide whether to participate or not, depending on how the reward is, and they can adjust. And last, small miners are price takers. So if I'm a miner and I'm very small, I can't really affect anything. I get to see all the pending transactions. I can select which transactions to include or not, but I cannot tell anybody, oh, you need to pay more in your transaction fees, because there's no reason why anybody would listen to me.
This is actually an interesting point. Like the system throughput is independent of the miners, but actually in reality, if there are more miners, the network delay will become longer. So
let's not get into this.
The same level of security issues. I mean,
let's call it the first approximation.
Oh, yeah. You're right. The real world protocol is like has this fixed parameter.
So a lot of those things are stylized quite intentionally to be able to think about issues a bit more cleanly, and we can think about whether when we make things more complicated, the results actually change. Let me hold off on this. Okay? So most of what follows is from this paper together with Gur Huberman and Siamak Molami. It's online. You're welcome to take a look at this. We're writing this, but I think the version online now should be legible. And we basically translate to a pretty standard economic model where we think of like those n miners. I'm going to count how many computing units of miners there are, call it n. I'm going to assume that there's many potential small miners that it can enter whose cost is Cm. The cost of mining per unit time is Cm. There may be big miners too. Blocks arrive at some process mu. Each block can process up to k transactions. And I'm going to assume that transactions arrive at some process as well. This is just for tractability. And the arrival rate of transactions is less than the system's capacity. So there's excess capacity in the system. And will show you, like that's the first point where you need to think that stochastic matters. If nothing was stochastic, it means that I have enough capacity to process everybody. When things are stochastic, I have enough capacity to process everybody on average, but I can have backlogs occurring. Miners get to select their fees. They have a heterogeneous delay cost that are linear per time. What they try to maximize is some reward from getting a transaction minus some cost of delay, where W is how long it takes for the transaction to get processed, minus some transaction fee they chose to pay. And I'm going to think of some users have a high value for transacting. Maybe they can't send the transaction in any other means. They want to send a transaction to Venezuela. They don't have any other system. Some others want to send something to their friends, and they can alternatively use Venmo. They may not use the system if it's not if the cost of using the system is too high. Okay? And importantly, whenever I talk about cost or values or any numbers, it's all in US dollars. Because the cost of miners is US dollars. The cost of delay should be denominated in US dollars. As long as I buy my mining equipment in US dollars, I care about what is the cost, not in Bitcoin, but in US dollars.
Right. Does this method apply also for other, like ones, especially Ethereum, ETH?
Yeah, but like let me not get into like some distinction, but largely yes. Okay? Okay, so just as a benchmark, what would a firm do? A firm would do the evil things that I talked about before. Okay? So a firm can set here two reasonable prices, either set price at the high price or at the low price. And if getting half the customers that pay the high price is better than getting all the customers at the low price, I prefer to charge the high price, and all the low-level customers cannot use the system. So I get the two problems that I said before. One is I exclude some customers, I price too high. Users get no surplus here. Now, all the customers here that buy something are exactly indifferent. They don't benefit really from using the system. The firm here gets all the benefits. And if I get locked in, and my willingness to pay for paying here, like suppose I disconnect for Venmo, my value went up, the firm would raise prices. Now, let's contrast it with what happens with Bitcoin. And to do this, I need to start thinking about now two sides in Bitcoin. In Bitcoin, there's going to be miners, and there's going to be the users. And I need to think about what is the equilibrium when both sides interact and each side optimizes separately. Let me start with the miners, which are simpler. So first kind of lemma result is that suppose some of the small miners, those miners that have cost Cm, suppose they enter. Then each miner is going to be a price taker. They cannot affect the prices that users will pay in transaction fees, and they will just do the myopically optimal thing of observing the pending transactions and just taking the k highest fee transactions. Because if I want to get the most reward for my block, I'll take the transactions that reward me the most. So I think it's pretty straightforward that you want to take the transactions that reward you the most. Why a large miner cannot do anything? Well, as a large miner, I can say, well, there's 90% chance that the next block is going to be mine. So if you don't pay $2 per transactions, you're probably going to get delayed. What that would do is make users increase their transaction fees. But that would cause more of the small miners to enter. If users pay more transaction fees, more small miners will enter, and therefore, like, all the profits that I get from raising the transaction fee will get dissipated away. Okay? To make this argument precise, I need to make the next calculation, which is how many of the small miners exactly enter. So a pretty common thing in economics is thinking about free entry implies zero profit. So the small guys, they decide either to turn on the computer or not. They turn it on when they can make money. They turn it off when they don't make money. So in equilibrium, it might make that they break even. So what is the amount of miners that makes those break even? So total payment to miners is the total transaction fees that people pay, plus the value of coins that we print. Okay? So let's say that we print S coins, and now because the coins are the only thing here that's denominated in Bitcoin, I need to put an exchange rate to get the US dollars amount, because the miners will care about how much I get paid in US dollars, right? Let revenue be the total revenue from transaction fees. The expected payment for being a miner is just this total thing divided by the number of miners, because I'm selecting one of them at random, and he's going to get the expected reward. So this must be equal to CM. The expected reward for a miner must be equal to the cost of those marginal small miners who enter and exit. So I get that the number of miners is equal to the total revenue divided by CM. And the way to think about this is I made the system totally competitive. And that means that I basically use all the revenue that they generate and buy miners at the cost of the marginal miner. So the marginal miners don't make any profit. They basically provide their services to the network at cost. If I'm a big miner, or I have a mining pool or a farm that has cheap electricity, then I can make money because I basically produce mining at a lower cost and sell it to the system at CM. CM is the price that the system procures its mining.
Sorry, what was CM?
CM is the cost of the small miners.
One problem that I have with this model is that it does not consider the case that actually reducing this mining, it takes a lot of time, and verifying it takes a lot of time.
So let me get to first some. Okay, I don't think I have much time, but first ballpark the fact that miners make zero profit, at least as 2015, that seems to be ballpark correct. Now the big problem, mining. The big problem with this argument is that if you buy an ASIC, it's not free entry and exit. You make a long-term investment that's predicated on whether mining will be profitable not just now, but in the long term. So that changes some of those calculations, but the general logic still holds. A reference to a paper that I just saw recently by Pratt and Walter study a pretty sophisticated by economically standard entry dynamics, where the miners decide to enter and exit, and they find that it's actually, they managed to fit the data pretty well, how much mining you will have, and I think there's interesting issues to dig into this. But in the interest of time, let me just continue to think of miners as being free entry. Suppose I don't need ASICs. Suppose I just mine with my own computer, I turn it on and off, the marginal miners make zero profit. And let me turn to analyze the users. So now, generally when you think of those two-sided markets, the users care about the other side. They care about the miners. But in this system, I made all the miners exactly the same. I select one of them at random. So I don't really care how many there are. Because I select one of them at random, I know that I'm going to have one miner every approximately 10 minutes, and he's going to process the block with k highest transactions. So as a user, I basically just respond to this congestion queuing game. I don't really need to think about the miners. I don't really need to think of this as a two-sided network. I just think of this as a system where I get to pay full priority. Blocks arrive, when a block arrives, the k highest priority transactions get processed, and the rest are still waiting. So now, why would I pay positive transaction fees? Well, if I pay a high transaction fee, it lowers my delay, because there can be backlogs. The ones who are going to get processed in the case of backlogs are the ones who pay more. So we basically need to analyze the following game. Like the user that has some cost CI, it says, I'm going to get some reward, and I'm going to have some cost from delay. That's going to be CI times how much my weight is going to be given how much I decide to pay, and the distribution of how much everybody else decides to pay. Like how much priority do I get relative to other people. And then I have to pay my transaction fee too. And another decision, I need to decide whether to send the transaction at all. If I send my transaction, I need to select the optimal transaction fee, the optimal B that will trade off how much I pay here versus how much I pay here. And if this entire thing is negative, I don't want to send my transaction at all.
What's CI again?
It's my delay cost per unit time. It's linear just because it's trackable. Okay, so how does this work? So in equilibrium, this delay actually has a pretty simple form. So if I have a higher delay cost, I'll be willing to pay more. And there's going to be two populations. People who have higher delay cost than me and higher priority than me, they're going to cut ahead of me. People who have lower transaction fee than me are going to be behind me, and basically they're invisible to me. I cut ahead of them. How much do I get delayed? Well, how congested is the system from the people who cut ahead of me? That's basically the number that matters. So I'm going to have this parameter rho. It's actually not on this slide. Why? Sorry, that's messed up. Yeah. Oh, here it is. So this rho is the utilization parameter, or the congestion parameter, or load parameter. It's how much demand for transaction I have relative to the capacity of the system. So by assumption, it's less than 100%. Is this at 50% or 90%? And what I care is not this percent, but what fraction of this is from transactions that have a higher priority than me. So this is the expression here. This is the part of the distribution that's ahead of me, that has higher delay cost of, and therefore cut ahead of me. This is my delay. This WK is just one function that, given the stochastic, calculates how long you will wait in number of blocks. And this mu minus 1 translates from blocks to calendar time. Okay, so we get this pretty simple expression. And then we can analyze, given this function, everybody should be optimizing. There's a pretty straightforward first order condition. This thing looks a lot like just the standard auction. And we get the following things. So first, users with higher delay cost pay a higher transaction fee and receive lower delay, not surprisingly. Transaction fees paid by user is exactly equal to the externality imposed on other transactions. So if I have a high delay cost, I'm going to cut ahead of other people. What I have to pay is exactly how much delay cost I impose on them by cutting ahead of them in line. And that's revenue equivalence from auctions, basically here. And another important thing is, if this rho is sufficiently low relative to this value of R and L, everybody wants to join. So when I cut in front of somebody, only causing delay, everything that I pay just depends on the delay. It doesn't depend at all on what my value is. So that means that payments in the system do not change if users' values go up. So here we get a very big distinction from the firm. The firm would like to raise prices until some agents won't leave. Here we get that you basically charge users how much they delay other users. That's a number that does not depend on how much you're willing to pay. That's kind of like cost-based pricing in a way. How much does it cost me to process you in a way? So I managed to raise transaction fees, and leave a lot of surplus to the users. Users will pay much less than they were willing to pay. How much do you actually willing to pay? Well, this is how your delay changes as a function of this parameter, of this congestion parameter. It's very flat here. Basically, if the system has less than 50% load, then nobody waits. It's very rare that you have any backlogs or any waiting. Once you get close to 100%, it starts to explode. Backlogs are very common and they take a long time to resolve. And more than that, here it's very convex. So I'm willing to pay a lot to just lower my load a bit. So people here will pay a ton, here people will pay nothing. So that means that, well, we had some fixed pricing in a way, but it's not necessarily the right number. It will change as the congestion changes. There's a couple of other ways in which it changes. Let me just repeat like the 2 points to compare to a firm. One, no deadweight loss. We can get strictly positive net surplus for all users. Everybody participates. Even if you send your transaction with 0 fee, you still get processed. I just make you pay delay. And users do not have to worry about getting locked in because there's nobody that can raise price on them. Just you know that the price is going to be fixed by this mechanism. But payments vary with the congestion. And now let's look at how payments vary with congestion. So this is just an expression for like the total revenue in the system. Let me show you this more empirically. So we can calculate, given those formulas, what is the total revenue the system will raise from transaction fees. And what you have on this chart is 2 things. One is the line, which is the theoretical prediction. This is just plotting the line, plugging in some benign parameters, like block size in Bitcoin during the period what we look at was about 2,000 transactions. And we took delay cost uniform and just scaled it to match the size.
But here you have the reward, the 20 reward.
So the block reward is not on this graph. I ignore this.
It affects the behavior of the miners.
So yes, but that's not relevant for how people pay the transaction fees. We said the transaction fees, you don't care about how minor they are, what happens with them, or how they're rewarded. So the fact that those block rewards do not matter for the sake of this picture. And the black line shows how does the revenue that the system raised from transaction fees change with the congestion. And you can see that it really matters. If there's no congestion, the system doesn't raise anything from transaction fees. If there's a lot of congestion, this explodes. And at some point, the calculation that they did was no longer valid, so some people will want to opt out of the system. But let's include this going to infinity for illustration. The other thing that you see on the slide is empirical data from Bitcoin. So we took days on the Bitcoin system, and for every day, we calculated what is the total transaction fee per block during the day, and what was the average size of a block during the day. And we say if blocks were on average 8 megabytes full, we're going to say that's 80% congestion, or 80% utilization, which is, I think, reasonable shorthand. And you can see that when you look at the plots, they don't exactly fall on the line, but you can see that the features of the line are basically paralleled by what happens in the points. And I think there are 2 important things to notice. Well, one is obvious. It explodes here. But the 2 other things that are important is you get no revenue if you don't have congestion. But if you have something like 80% congestion, then you start getting revenue already. And here there's excess capacity in the system. It's not that people are paying because they can't get into the blockchain. They're paying because they want to get into the blockchain fast. And I said that the Poisson arrival prices, the randomness of the blocks matters. Here's why it matters. You can actually get revenue when you have excess capacity. Because when you have a stochastic system, there's going to be delays. That's something that you can price. I go to...
I have one question about the last chart.
What?
About the last chart.
What?
I had a question about the last chart.
Yes.
Basically, like, how is this transaction fee related to the price of Bitcoin? Like, what I'm wondering is there any like finer test of the model that you can do that's like a little bit less independent of random price fluctuations and a little bit more dependent on, say, the the amount of time delay or something like that?
You can, comes out similar. Yeah.
So for miners, what is the optimal like utilization? Like I should maintain it at 0.8, like 80% utilized to make the maximum revenue.
What do you mean? Miners would like users to pay as much as possible, right? So they would like utilization to be as high as possible, given that users don't leave.
So you are saying miners would be incentivized to.
Yeah, and that kind of played out when like the block size increased, like the debates before SegWit. Miners were kind of aware that if you increase the block size, transaction fees will go down, that's exactly what happens with Bitcoin Cash.
So, but then the miner can just inject zero fee transactions and like create congestion, and then there's going to be a huge backlog. So
but if you inject zero fee transactions, you don't actually push out any transactions that are willing to pay positive prices. And if you want,
I guess that's what I'm asking. I guess if like it becomes close to 1, the number of transactions you can actually confirm and benefit from becomes like smaller.
So maybe we should talk about this offline. Yeah.
So on your next slide, the last one you're making, seems to be suggesting that. Can you go? Yeah. So you're saying basically that revenue for miners is good because it incentivizes infrastructure that supports the payments. But in the Bitcoin network, at least right now, most of the infrastructure is used not for processing the payments, but for processing the puzzles. So at some point, costs are too large for people to join the puzzle. People just go down and.
So very good. Yeah. So
working.
So what you're saying is, this was not a problem for Bitcoin because they actually have the block rewards sustaining those payments. And at some extent, this was unnecessary because the block reward was too high anyway. Why do you need transaction fees on top of this? And this is kind of like maybe the next point. Sorry for skipping things, but if you think of the market for crude oil, one of the main functions for like a marketplace, I should wrap up. Yeah, so let me wrap up with this. Okay? So one of the main functions of a marketplace is to coordinate supply and demand. So you can think of Bitcoin made this computational service, this financial services, a commodity. And now anybody can do this. We can buy this at a marginal cost, like a commodity. But the market for oil regulates the supply of oil. It makes it that if there's more demand for oil, we get more oil producers to come up. If the price of oil comes down, some shale fracking will close down and we'll get less oil and we'll adjust how much oil we need. The system as is just has a fixed capacity, and congestion will affect how much money are we raising from transaction fees, and that has nothing to do with whether we want more or less miners. So the thing I'm not going to cover here is that you can think of having a protocol that actually adjusts the congestion to get the number of miners that you actually need. And there's some good things that you can think about this. It allows you to target some revenue in USD. Okay? But in the interest of time, let me just finish here and leave time for the panel that I'm sure you're much more interested in. Okay? So thank you.
You mentioned that doesn't work for ETH because the delay there is different from Bitcoin. Ethereum is different from Bitcoin, the type of.
So let me talk to you offline about like differences. Yeah.